Warren Buffett has more cash right now than most countries have in their entire national budget. We're talking about $300 billion sitting in cash and treasury bills and doing absolutely nothing. And when the world's most successful investor decides to stop buying, that's when you should start paying very close attention to your money. In the next 10 minutes, I'm going to show you exactly what Buffett is doing, what he sees coming that most people don't, and, most importantly, what this means for your savings, your investments, and your retirement. Let's start with the numbers. Berkshire Hathaway, Buffett's company, ended 2024 holding approximately $325 billion in cash and short-term treasury bills. That's not a typo. $325 billion in cash. To put that in perspective, that's more money than the entire GDP of countries like Denmark, Singapore, or South Africa. It's more than Apple spends on research and development in a decade. It is an almost incomprehensible amount of money for one company to hold in cash. And here's what makes this number truly alarming. It keeps growing. Quarter after quarter, Buffett is selling stocks and putting the proceeds into cash, not into other stocks, not into real estate, not into anything. Cash. For a man who once called cash a bad investment, this is a complete reversal. And when Warren Buffett reverses course, the world should pay attention. So what exactly is Buffett selling? Let's start with Apple. In 2024, Berkshire Hathaway sold more than half of its Apple position, over $100 billion worth of stock, in a matter of months. Apple, the company Buffett called the best business in the world, gone, more than half of it. He also sold Bank of America stock, reducing his position significantly. He trimmed holdings in major banks and financial companies. He sold HP, Chevron, and reduced positions across the board. The pattern is clear. Buffett is not repositioning into better stocks. He is exiting the stock market, and he has been a net seller, selling more than buying, for more than 8 consecutive quarters as of late 2024. Think about that. 8 straight quarters of selling. That's 2 full years of Buffett getting out of the market. Now here's where it gets really concerning. Because this isn't the first time Buffett has done this, and history shows what happens next. Before the dot-com crash in 2000, Berkshire held an unusually large cash position. Buffett refused to buy tech stocks because he said they were overvalued. Everyone laughed at him. Then the market crashed 49%. Buffett had cash to buy at the bottom. Before the 2008 financial crisis, Berkshire's cash reserves were growing rapidly. Buffett wasn't buying the housing boom, he was watching. And when the crash came, when banks were failing and markets were collapsing, Buffett deployed billions into distressed assets. He made fortunes buying the wreckage. The pattern is this: Buffett holds cash when he thinks the market is overvalued. He deploys it when he sees a crash. And right now, he's holding more cash than ever in Berkshire's history. More than before 2000. More than before 2008. What does that tell you? Here's the part that directly affects you. Most people think Buffett stuff is for billionaires. It doesn't affect me. That's the wrong way to think about it. When the stock market corrects significantly, and historical crashes have ranged from 30 to 50%, your 401k, your IRA, your retirement account, all of that drops with it. If you have $200,000 in retirement savings and the market drops 40%, you just lost $80,000. That's real money. Years of savings, gone. And the signals right now are unusually strong. The S&P 500 was trading at extremely high valuation multiples, among the highest in history outside the dot-com bubble. The Buffett indicator, market capitalization to GDP, was near record levels. Corporate debt is high. Consumer debt is high. Interest rate pressure is real. Buffett isn't the only one seeing this. Hedge funds and institutional investors have been reducing equity exposure. Central banks globally have been buying record amounts of gold. Smart money is quietly, systematically moving out of risk. So what can you actually do about this? I want to be clear. This is not financial advice. Always consult a qualified financial advisor for your specific situation. But here are 3 things that many analysts discuss in this environment. First, review your asset allocation. If you're 100% in stocks and you're within 10 years of retirement, a major correction could be devastating. Many advisors recommend holding some cash or bonds as a buffer against volatility. Second, consider reducing concentration risk. If you're heavily concentrated in one sector, especially high multiple tech stocks, that's where the biggest losses tend to happen in corrections. Diversification isn't exciting, but it's what protects you when the market turns. Third, don't panic and don't try to time the market perfectly, but do have a plan. Know what you will do if the market drops 20, 30, or 40%. Having a plan prevents emotional decisions that destroy wealth. Buffett is doing what he always does, being patient, holding cash, and waiting for the right opportunity. The question is, will you have the resources and the calm to act rationally when that opportunity arrives? If this helped you understand what's really happening to your money, subscribe to Finance Alert Global. I publish new financial alerts every week, so you're never caught off guard when markets shift. Hit the subscribe button below. It's free, and staying informed may be the most important financial decision you make this year. See you in the next alert.